opening remarks. I think the opening remarks are always a ploy to prepare the audience for 15 minutes. So both of the speakers are here. Those of you who don't have this little booklet should get it whenever you go out again outside. This gives you all the bios. But I'll very briefly, therefore my introduction of the two speakers will be brief because we want to really spend the time on the substance. Our principal speaker, the paper presenter, is Dr. Krishnamurthy Subramanian. He started as a professor at the Indian School of Business after doing his PhD at the University of Chicago, and has been a prolific contributor to scholarly research, is publishing in most of the leading journals in finance. He then went on to be the chief economic advisor of India to Prime Minister Modi, and completed a fantastic full term. And now he has joined as the executive director at the International Monetary Fund, representing India, Sri Lanka, Nepal, and Bangladesh. He's also emerged, during this period as a Twitter star, as those of you who follow him on Twitter would know. To my left, Dr. Poonam Gupta. She is a great scholar of macroeconomics, particularly, I think, if you're talking about India's macroeconomics, it's hard to think of anybody better. I certainly go for my macroeconomics questions to her. She did her PhD at the University of Maryland and worked for both the International Monetary Fund and the World Bank. And now she is the Director General of the National Council on Applied Economic Research in New Delhi. And she is also a member of Prime Minister's Economic Advisory Council. So each of these two individuals have a direct line to the Prime Minister. So, if you want to have any messages, suggestions conveyed, don't give those suggestions during Q&A. Q&A is only for asking questions, not for commentary. But afterwards, they are both here through the day. So you'll have the opportunity to pass on all your great ideas. With that, we'll begin. Subbu?
Thank you very much, Dr. Panagariya. I will use the presentation. I think it works. Yeah. So first of all, let me start by thank you, Dr. Panagariya, and all the conference organizers for allowing me to present this paper. It's a privilege to be here.
Yes.
Okay. Well, it's recording. This is a paper that is still work in progress, so I really look forward to your comments, Poonam. There will be some stuff that I have included that I did not send it as part of the paper that I sent, for your valuable comments, primarily on the employment situation. So let me start by talking about, having been in the North Block at the time when the once-in-a-century pandemic, hit. I think all policymakers across the world really had to think very hard about how to, deal with the crisis. So this paper is based a lot on my own, personal journey at that time, and the thinking that we undertook in responding to the crisis. So I think the crisis, because it was a health crisis, and it was different from the, from the previous crisis, there was no playbook really to sort of, to latch on to. India's policy response, as I'll explain, drew a lot from the Spanish flu pandemic a century back in 1918. I'll give you a little bit of a background here. Around mid-March, so we just finished the economic survey, and the budget. And then, we basically were hearing about stuff that was happening in Wuhan. my team at the North Block, and I had a fantastic team there, did some estimation of the data from Wuhan, and then for internal purposes did some projection about if there is no lockdown, what would happen. So they did a projection, and what they found, and the analysis that we had started at that time eventually appeared in the chapter 1 of the Economic Survey 2021, where we had using the population density, the population, realizing that COVID is like a network phenomenon which would spread much faster in a larger population and also with a higher population density, had estimated that if there is no lockdown, we would be looking at about 80,000 deaths, by May. This was the estimate that was done at that point in time. And at this, now I can share. As was the case, my meetings with the Honorable Prime Minister used to be one-on-one in many cases. So I went to him around mid-March and said that. First thing I said is that this presentation, this recommendation that I'm making to you, I'm not making it as a chief economic advisor, because what I'm going to recommend is that we do a lockdown. And if there is a lockdown after you, possibly the maximum amount of criticism is going to come to me, because the economy obviously will get impacted significantly. But this is not the time to actually think about, from our sort of small minds. That's a word that I used. From our respective positions, I think we have to do what is right for the country, and that's basically how I was asked to then go and present that to the principal secretary as well, and so one of the and starting from that point in time, what we. What we did, and I think I was really privileged to be part of a team that really looked at the big picture, and trying to oftentimes go beyond the call of duty to do what we thought was right for the nation. Obviously, there was a lot of learning, by as we went along. But one of the key learnings for me, was I remember reading this NBR paper that looked at the 1919 Spanish flu pandemic and the non-pharmaceutical interventions that were done at that time among US counties. I'll show you that particular chart, and that was quite informative in thinking about so I'm not going to focus that much on the health side. It's been covered in the economic survey. I'm going to focus more on the economic response to this. The learnings that at that time, I also decided to go and study very carefully our response, India's response to the global financial crisis and to the Asian financial crisis, and see what learnings we could pick up from there. And that helped us then, design the response to the COVID shock. That's sort of the background to. So this is what we. I'm going to quote from the economic survey. Faced with the unprecedented uncertainty at the onset of the pandemic, India focused on saving lives and livelihoods by its willingness to take short-term pain for long-term gain. India's response stemmed from the humane principle that was advocated in the Mahabharata. In fact, I remember this quote, when I made the presentation to the Honorable Prime Minister. I had used this quote from it appears in the Shanti Parva of the Mahabharata, which says, Apadi prana rakshahi dharmasya pratham ankuraha. In Sanskrit, what it means is apada is actually difficulty. When faced with a crisis, or saving a life that is in jeopardy, is the origin of dharma. Dharma is a Sanskrit word. Ethics is a partial sort of capture of the spirit that is in that word. So that's basically what guided India's policy response. India recognized while GDP growth will recover from the temporary shock caused by the pandemic, human lives that are lost cannot be brought back. Now you have to keep in mind, and we can talk about this when we have the Q&A. Given India's health infrastructure, and given our population, given the population density, our response had to actually be tailored accordingly. So The response drew on epidemiological and economic research, especially pertaining to the Spanish flu, which highlighted that an early intense lockdown provided a win-win strategy to save lives and preserve livelihoods via economic recovery in the medium to long term. So I'm going to show you this particular, so this, as I referred, I mentioned about this NBER paper. This chart was quite informative. I remember reading this particular paper and, really been sort of looking at this particular chart with a lot of attention. So what this shows clearly is, I think there are two sets of dots here. There are the blue ones and the red ones. This is, variation across counties in the United States during the Spanish flu pandemic. And you have mortality plotted on the x-axis. You have, change in employment as a proxy for economic activity, over a 5-year period, 1914 to 1919. What is, of course, quite obvious is basically the negative correlation there. But what I think the more important part was, if you look at the cluster of the blue dots versus the cluster of the red dots here, and that's quite informative. The blue dots are the ones where basically mortality was lower, generally more clustered towards the left, on the x-axis, and the employment growth was better. In contrast, the red dots, these were the ones where there was basically high mortality and low growth. And as you can see here, the red ones were the ones where the interventions, non-pharmaceutical intervention, NPI days, actually were below median. In other words, the lockdowns were not as intense, while the blue ones were the ones that actually they were intense. So this was an important learning that actually guided India's, response, the health response to start with, and then came, of course, the economic response. So it's important to also appreciate some of the preconditions with which we entered COVID, and I will contrast this to the global financial crisis. So India entered the pandemic with an economy that was slowing down, and I've covered this in great detail in the economic survey, which basically showed clearly that the decline in investment, because of the financial sector problems, myriad of problems, they've been covered in detail, starting from the banking sector, moving on to the non-banking sector, and thereby which lowered investment. So the net result of that was India entered COVID with an economy that was slowing down. Now, that also meant that there were going to be, obviously, then there were ratings, outlook downgrades, and we were actually doing this as we were, entering COVID. We were also talking to the rating agencies that actually, had downgraded our outlook. Importantly, this is very important for us to take into account, the contrast between emerging economies that actually have to take, such aspects into account vis-a-vis, advanced economies, I think is important. That India's sovereign rating, was just above non-investment grade. Now, I've written again about this. I don't think this rating actually reflects fundamentals very well, but be that as it may, it was what it was. And if there was a ratings downgrade, to follow up with the on the ratings outlooks that were downgraded, then there would have, it's a discontinuity, because pension funds, other institutional investors, all of them, they cannot invest in an asset that is non-investment grade. So if we went down from the rating that we were, just one notch downgrade would have meant significant capital flight. So I think that is basically the really important precondition that was, this also has been shown in the paper chapter that I'm referring to, that while the markets, forex markets, fixed income markets and equity markets in India do not react to changes in ratings otherwise, when it is an investment grade to non-investment grade or vice versa, these markets do react significantly because of the discontinuity, from foreign inflows, FDI and FPI. And I think that is, one of the key worries that we were actually, we were obviously in touch with the ratings agencies, trying to convince them, if that the rating itself does not reflect its fundamentals, but at the same time also conscious of the, if they actually do not listen to what we have to say, we may be looking at a ratings downgrade. And so that was one of the key, aspects that we had to be conscious about. And I think what we realized was if we did not manage this balance between growth on the one hand and fiscal spending and inflation on the other hand, then we might be looking at a ratings downgrade. And that was because the outlooks, the downgrades in the ratings outlook happened because of slowdown in growth, which told us that growth matters. But at the same time, seeing some of what had happened during the global financial crisis also told us that, if you basically spent like there is no tomorrow, and then that led to inflation and other problems, that would also put us in enormous amount of difficulty. And therefore, we had to actually get this balance between, growth on the one hand and fiscal spending and, and inflation, almost sort of perfectly right if you had to avoid the ratings downgrade. So that was the precondition with which we entered. So this chart actually captures, in some sense, how India has sort of emerged from COVID. This is for the top 10 economies, large economies. What you find here, so let me just quickly explain. On the x-axis, what is plotted here is the inflation from March 2021 to December 2022 as a multiple of historical inflation. And the reason that is being done is to look at the change in inflation compared to historical average vis-a-vis the 3-year GDP growth. And that is to actually account for the decline during COVID and then the recovery after. So that's why you see the 3-year GDP growth plotted on the y-axis vis-a-vis change in inflation. The reason here is that, of course, all countries expanded fiscally during COVID, and that obviously would have accounted for growth, but at the same time is also manifesting as inflation now. So what the takeaways here are primarily two. For the moment, ignore India. Just take a look at the remaining countries. You see a very, very tight relationship, among the remaining countries between inflation, as a percentage of historical average and the 3-year GDP growth, which basically tells you that primarily this growth, that manifested over a 3-year period is also actually manifesting as inflation, a very strong correlation, and India stands out as the positive outlier there. And that's what I'm going to talk about. Why is it? What were the policies that we actually implemented that led to, this kind of performance? Okay. So a theme that's going to run through, the way I look at it is let's look at the, economic response by the advanced economies during the global financial crisis and COVID-19, India during the global financial crisis and COVID-19 as well. As as is explained in the paper, I may not have time to go through in detail. The response, by the advanced economies and many of the emerging economies that copy-pasted the response that, advanced economies had, focused primarily on the demand side, thinking about, the COVID crisis as a demand side shock, which every economic crisis always is, undoubtedly. But I think what we recognized was that this crisis was going to be different. COVID was different because it also going to be a supply side shock, which I think a lot of countries have realized now. But thankfully we had the foresight to be able to recognize that, before we entered or while we were entering COVID. So when you will see, I'll contrast India's response during the global financial crisis and the, if you look at the advanced economies as well, it's primarily a demand side response, recognizing that the crisis is a demand side shock. I'll contrast both of these vis-a-vis the Indian response, which was a balanced supply and demand side response, and that is why what we actually are seeing here, to me, it is, because of the supply and demand side response, together. Okay, so what the paper primarily does is, contrast the policy, India's to policy of other countries, and India's own policy during the global financial crisis. This year India is expected to grow at 7%. And if you look at the macro fundamentals, whether it's inflation, whether it's current account deficit, you look at fiscal deficit, those are all actually in much better situation. I'll show you the detailed data in one of the later slides. So I think the contrast vis-a-vis global financial crisis is palpable. 15 minutes? Okay. If you look at COVID-19 was a supply side, huge shock to supply because supply chain disruptions actually, and the fact that, when you shut down the economy, you cannot rev it back to full capacity, immediately. And when you look at advanced economies, as I showed you, actually, they're facing about 2.5 to 4 times inflation. India, has inflation that is actually less than its historical average with 7% growth. So this is something that was covered in the, I'd mentioned it in the economic survey, and I think this is, we recognize, this is not exposed, that the crisis affects both demand and supply. If you go and read the economic survey, it says that unlike previous crises, the COVID pandemic affects both demand and supply, and the possibility of hysteresis as well because of labor being impacted. Therefore, we actually embarked on reforms as well, structural reforms. At the start of the pandemic, and this is where again some of the nuanced differences, at the onset of the pandemic, India's policies focused purely on necessities. The food program that actually India embarked is by far the largest in the world. 800 million people were given free food, and as I'll cover, actually the fiscal cost of that was not very high. This was optimal given the uncertainty and the resultant precautionary motives, as you're seeing now in the US as well. For instance, savings have gone up. I have a Twitter thread showing how the current banking crisis itself is because of the suboptimal response by the US government. Essentially, we recognize that pushing down on the accelerator while the brakes are clamped, during the lockdown, and during the first phase of COVID, actually only waste fuel. So it's only during the unlock phase that demand-side measures were implemented. And one of the key characteristics of India's, economic policy was a public investment program, huge increase in public capex. So this is a slide that I want to spend some time on, contrasting India's, response during COVID vis-a-vis global financial crisis. Here you have a dozen macro indicators. First, the three metrics that are important to look at: inflation, fiscal deficit as a percentage of peer economies. That is important because every country expands, fiscally during a crisis, and therefore you have to look at it in a relative sense. Current account balance. Then you have the revenue expenditure. This is important to see, actually. If you see revenue expenditure increased by 27% during the global financial crisis, it increased by only 5.9% during COVID. Capital expenditure, on the other hand, increased by 13% during COVID. It declined by 4.8%. As a result, gross fixed capital formation in the economy as a percentage of GDP declined by 4.5% during GFC. It's increased by 2.2%. And this is despite some of the the crisis on crisis, the war that has followed COVID. If you look at INR depreciation, unprecedented depreciation during the global financial crisis, much less. And as among major currencies, Indian currency has done far better. Even if you look at government bond yields, those increased by 4% because of the revenue spending and possible market anticipation of crowding out. In contrast, only 0.9% during COVID. If you look at external debt, not very different. Forex reserves, of course, much higher, and FDI and FPI. And I think these are also indicative of the markets looking at the way in which India responded during the crisis, COVID versus global financial crisis. So this is something we all, I think, it's useful to, if you think about just a laissez-faire sort of, you do nothing, there's a demand side shock and a supply side shock. So, huge decline in output, but inflation is not a problem because the demand and supply side effects offset each other. What India did during the global financial crisis and what other countries have done now is primarily on the demand side, which actually leads to inflation, does arrest the impact on output. But what India has done during COVID is basically both demand and supply, and therefore we're actually facing less inflation because the supply side measures actually have offset some of the demand side measures on the inflation front, and also gives a much bigger kick to on output. So these were the principles that actually drew. I've covered it in more detail in the paper. Primarily, I think to this audience, the first principle is obvious, but I want to focus on the other principles. So macro policy that focuses only on demand delivers short-term growth but long-term high inflation, while macro policy that focuses both on demand and supply delivers long-term growth. Without high inflation, revenue expenditure, leads its myopic policy making, while capital expenditure actually, and in the Indian context, there's also papers by Ashima Goel and others showing that it also helps to bring down inflation, by increasing the supply response. I think capital expenditure crowds in private investment, while revenue expenditure crowds out private investment. And especially in a crisis, because of the risk aversion of the private sector, investment goes down significantly, and therefore it is important for the sovereign to step in to increase, capital expenditures, and that's what we did during COVID. So if you look at the, in a cross-country comparison, I think when you look at the measures that we implemented, one of the key things was that the free food to 800 million people, there was no fiscal cost to this, in the year of COVID, because this was already procured, food that was procured and was sitting in the warehouses of the Food Corporation of India. And what we did was basically tapped into that food that was already stored in order to actually, take care of the necessities. And if you look at even early on during the papers showing, even in the US, the checks that were sent actually were spent far more on the necessities. We took care of that through in-kind transfers. And the other important point is that India used the below-the-line measures, contingent liabilities, especially sovereign guarantees, significantly. That accounts for almost 60% of the overall measures. So if you look at capex, and this is something which actually I've shown, there's been a clear increase, through the emphasis on the capital expenditure, as a cornerstone of countercyclical fiscal policy, the case for which was made in the Economic Survey 2021. These are charts showing basically correlations. Gross fixed capital formation also actually has increased using the latest economic survey data. It did dip during COVID. Okay, so in terms of the majors, in the interest of time, I'm not going to go into detail. The paper has all these, what were the supply side measures that were taken, what were the demand side measures. I want to focus on a couple of important aspects here. The first one on the supply side was the credit guarantee scheme. Many of you would recall at that time there was a clamor for an urban Manrega, and we resisted that significantly. And the reason for that, I think it's think about actually a borrower facing liquidity and solvency problems. If there is no liquidity, neither a liquidity nor a solvency problem, such people basically don't need any help. And a sovereign spending that actually does not target also benefits these people, and goes and just sits as savings, which is what has happened in the US. This is a cell that we don't need to consider, because if somebody doesn't have a solvency problem, has a solvency problem, likely will have a liquidity problem as well. So let's focus on these two cells here. And the most important, first one, let's focus on, think about a borrower that is facing both a liquidity problem and a solvency problem. Genuinely distressed, needs government help, but it's hard for the sovereign to identify, using granular data, who is this category of borrower who's actually facing both a liquidity risk and a solvency, problem. And this is where, we use banks and, MFIs. Typically, banks and MFIs would not, MFIs, I mean microfinance institutions, will not lend to this borrower, because of the situation. He's facing a solvency and a liquidity problem. You overlay a sovereign guarantee on that, the bank is now willing to lend. But importantly, because this borrower is facing both a liquidity and a solvency problem, unlikely that he or she will repay that loan, and that's when the guarantee kicks in. Through the guarantee, therefore, through the financial sector, to this category of borrower, it ends up becoming a quasi-cash transfer, because, this borrower actually does not repay. In contrast, if you take someone who's actually facing only a liquidity problem, is not facing a solvency problem, you want to give this person a loan, but you also want that person to repay, because he's only facing a liquidity problem. Now, here's where, again, the financial sector really comes in, because financial sector has granular information, and also, because of credit scoring, the incentive comparability constraint, if sovereign were to actually just do a fiscal transfer, this person would actually, it would waste precious fiscal resources, because this borrower only needs temporary help, does not need permanent help, and that works through a loan. And that's where actually the use of the financial sector with the guarantee from the sovereign actually was a very important aspect of the, as benefits were granular information that the financial sector has on the borrower, which the sovereign does not have, the incentive compatibility constraint for the borrower to actually, because he or she cares about the credit score, to repay, when he is in a position to repay, which would be basically this particular category of borrowers. And financial leverage, and more importantly, the payment actually made by the fisc happens only in better times, not in the times when the tax revenues actually are bad. So if you compared to a fiscal spend, when the money would have had to be spent in the COVID year when tax revenues are very bad, this is basically postpones that payment. It's a contingent payment that gets made only to those borrowers who are the real needy. So this was used both for SMEs and for the urban poor. And we resisted the clamor for urban Manrega. Instead, we used the lending with guarantees, lending by microfinance institutions who actually serve the urban poor significantly. So there's now a lot of research that shows that this was a very important part of the COVID package, overall COVID package, showing that about 1.35 million MSMEs actually accounts were saved, which was equivalent to about 14% of the outstanding credit. And if these had turned NPA, about 15 million workers would have become unemployed, which might have impacted about 60 million folks. Critically, this was focused far more on the trading sector, essentially including small kirana shops and mom and pop shops. These were basically the ones that benefited, followed by food processing, textiles, and commercial and real estate. Food processing was actually impacted significantly during this period. So these are some of the slides showing how many people benefited. So let me just quickly, Manrega spending increased significantly. I just want to spend the last couple of minutes to talk about employment, the impact on employment. This is data from the PLFS, the NSSO PLFS data. And what I'm going to show you here is all three metrics, the worker participation ratio, the LFPR, the labor force participation ratio, and the unemployment rate, how that has actually reacted to COVID. What you will see, and this is something which is a sort of a sanity check, you will find that all these measures actually are, reacting the way we would expect as economists during the lockdown and the second wave, which was quite bad as well. But it recovers after that. So the sanity, test that we actually expect, the data, the PLFS data passes. So this is for the worker participation ratio. You see that V-shaped recovery. Importantly, it's actually higher than pre-COVID levels. You'll see that across, all of these measures. If you look at it separated by males versus females, males you actually see a very sharp V-shaped recovery, decline during the second wave, but again, at 68.6 vis-a-vis 67 pre-COVID. If you want to take even the month before COVID, even then actually, it's higher than pre-COVID levels. If you look at it in females, actually here, the recovery is not as sharp. It's not, as V-shaped. It goes up, it recovers much more slowly. And that I think is expected because the females were actually the sort of, having to be caretakers during COVID. And that's why you'll see across the board, whether it's worker post participation ratio, LFPR, or unemployment rate, that the recovery for females is actually not V-shaped, unlike that for males. But it does end up actually being higher than pre-COVID levels, even if you take the month before COVID. These three charts were for workforce participation ratio. Let me show you the next for LFPR. So LFPR, it's not as V-shaped, but does actually go down during the lockdown and the second wave. Has ended higher than pre-COVID levels. This is across males and females both. If you look at for males, the recovery is very, very sharp, V-shaped recovery, and does go down during the second wave, and it's at almost the same level, a little lower than pre-COVID levels, 73.7 versus 73.3 for LFPR. If you look at the female LFPR, is again, does not recover as fast, but has ended up higher than pre-COVID levels. If you look at the unemployment rate, you see the inverted U here, inverted V, sorry, where Unemployment rate, reached historically high levels during the lockdown, 20.8, but has since come down. And if you now, if you look at post-COVID, it is lower than pre-COVID levels. So any suspicions that many of you might have, oh, this data is actually not good, I think, I myself checked that as well, because I wanted to make sure that, the data is actually saying the right thing. These sanity checks clearly, suggest that the data is of high quality, and this is the NSSO's labor force participation. If you look at for males, again, the inverted V is actually quite sharp, but not as much for females. Again, female, the unemployment rate actually recovers, at a slower pace, but is actually now lower than pre-COVID levels. So the overall employment situation is also, improved significantly, which is, which is testimony to what I spoke about, earlier on the policy response. This is again two other sets of data just to convince you that what the NSSO data is showing is also being seen in other sources of data. Which ones? Yes, for the quarterly, yes, quarterly. I'm going to show you the Manrega for the rural as well. Yeah, that's a good clarification. I agree. But even so, the paper actually that has the annual PLFS is for both urban and rural, and the 2022 data has come, and that shows that even taking into account urban and rural, employment situation has improved, compared to pre-COVID. If you look at the EPFO data, you see the same kind of pattern here with EPFO as well. Decline during lockdown and during the second wave, and has improved since then. If you look at the annual numbers in terms of EPFO data, clearly the additions are much higher than pre-COVID levels. And finally, if you look at the Manrega data, Manrega is distressed employment, especially in the rural areas. And here as well, you see the similar pattern. Significant increase in demand for Manrega during the lockdown, and then during the second wave as well, but has since come down, much below the pre-COVID levels. I understand many of you here, especially, will have your own priors, and I think a paper that basically says that India did far better than the advanced economies in responding to the pandemic is something that is definitely going to shake priors. I am absolutely cognizant of that. Hopefully, I've actually given you data, and evidence across different metrics to at least make you think that maybe there is a story here. So let me, this is something which I don't have time for, but let me just quickly conclude. Though India entered COVID with economic difficulties, India has emerged strong, through economic policy that actually, I think, diagnosed the crisis well, especially the supply side shock that COVID, created, and a policy that then responded by implementing both demand and supply side measures. I'll stop there. Thank you very much.
Can somebody help me with the slides?
Yeah, he will do it. Yeah. Don't worry. Which one is yours? NCAER, right?
Yeah.
It will just come.
Let's just wait for the slides to come up. Really happy to be here. Thanks to Professor Panagariya, SIPA, Deepak Raj in the center for this kind invitation. Hard to discuss a paper by Dr. Subramanian, not just because the paper is very good, but hard to match his energy level. But I'll do what I can do. So the paper is comprehensive. I got a slightly preliminary version, but I understand he has worked on the paper more since then. It has some very clear messages. And let's just wait for the slides to come up before I go over the messages that as I see them. All right, so, all right. The Indian economy has emerged quite unscathed from COVID. The economy has been growing well. There are no signs of any permanent scarring, which is great, which means that India will continue to grow at very rapid pace. The part of the paper that I read and I'm going to comment upon has well documented India's policy response during COVID in two areas, fiscal support and regulatory responses. I don't recall whether the lockdown as a policy was in the paper, but I certainly didn't prepare my comments on that. Whether it was the right time, the right duration, the right implementation of lockdown is not something that I'm going to be talking about. I actually read the paper mostly for the fiscal support and regulatory responses during COVID. On that, the support was timely, good quality, in the sense that it was spread as widely as possible within a prudent fiscal envelope. The benefits were distributed efficiently using the digital infrastructure that the country had been laying down for years. The paper also compares the policy response that was taken during COVID with that was taken during the global financial crisis, and compares the response with advanced economies. And we just heard an excellent presentation from Dr. Subramanian on that. As a result, both demand and supply recovered at a nice sequential pace. They did not outstrip each other, which means that growth occurred without inflationary tendency or without compromising the macroeconomic stability, and all of it is well taken. So then how do I comment on a paper that you mostly agree with? So I still have to do my job. So there are 3 or 4 things that I want to talk about. Yes, policy response during COVID mattered. In addition, what mattered was the work that had been going on for years prior to COVID, which meant that India was already in some sense in a very strong position when COVID struck to handle the impact and to get the most out of the policies that were implemented during COVID. Some of the exogenous factors also made it a little bit easier to handle this crisis. Comparison with advanced economies is relevant, but I find it even more useful to compare India with other large emerging markets and developing economies. They are the right comparators. They are also the same asset class that India is in. It's a polite way for me to say that I don't compare India with advanced economies. It does not make a whole lot of sense. But we cannot declare economic victory as yet. There are a lot of challenges that persist in the economy, and we need to continue to work on those. So when I say India was already in a strong position on eve of COVID, what exactly do I mean? There are 3 kinds of things that I have in mind. There was political stability in the country, there was policy stability in the country, and there was macroeconomic stability in the country. There were no crises that were emerging anywhere. India was just actually during the year 2021 was emerging, having handled a crisis in the non-bank financial sector, and that had been handled well. A few years prior to that, a banking crisis was handled as well, and both of these crises were under control, and these segments were emerging stronger from their respective crises. India had made great progress in financial inclusion and digital and technology adoption by the vast majority of the population. Again, something that made it easier to handle the impact of the crisis. It was easier enough to then send relief rapidly using the financial and technical and digital infrastructure and adoption that had happened in previous years. Just imagine if all of these things were not there. Even if the response was taken, as Dr. Subramanian so convincingly told us about, we would not have been able to come out of the crisis the way we did. So when I say no macroeconomic instability was evident, here are a few variables that macroeconomists talk about. Inflation had come down, was barely at on average, about 5.5% prior to COVID. Current account deficit was really low, which was not the case during the global financial crisis. Prior to that, for a number of reasons, including mismanagement of the economy, but also very high oil prices, current account deficit was very high. So around this time, entering into COVID, current account deficit was less than 1% of GDP. Fiscal deficit had been brought down by years of hard work. It was not just that the fiscal deficit had been brought down, it had also been made more transparent and more cleaner, in the sense that nothing was below the line or hidden under the rug to come out later, to emerge later. So as a part of macroeconomic stability, fiscal deficit was also lower than in the past. Now keep in mind, India is an outlier when it comes to the level of fiscal deficit and debt in its asset class. Sorry, I have an allergic cough, just give me a second. So despite those levels of debt and deficit, bond yields on government debt had been declining again for a few years, a reflection of the macroeconomic stability that country was in and was actively pursuing as a part of the policy. Banking sector cleansing was almost over, reflected in the non-performing loans that had declined, had started to decline, return on assets that had started to increase. So massive financial integration and digitalization of the economy was underway. I have here about 6 to 7 indicators, but there are many more which I have not included here. Jan Dhan accounts had proliferated, had doubled in a short period of 4 years, from 18 crores to 37 crores in August 2019. RuPay card issued on Jan Dhan accounts again had nearly doubled during that short period. Number of smartphones used in India as percentage population was nearly 50% on eve of COVID. Internet subscribers similarly were more than half of the population. People were getting more and more comfortable with electronic payments, and this is reflected in both in value and volumes. This infrastructure made it much more easier for India to then take the policy responses that they did and to get the impact that they got. It also meant when everything became digital and online, be it retail, be it banking, be it education, be it health, population was prepared for it, having gotten the infrastructure, financial literacy, and comfort with using digital. So this entire infrastructure helped India emerge out of the COVID crisis better than it would have. A couple of exogenous factors which made it slightly easier to, not to take away the thunder from Dr. Krishnamurthy Subramanian or anybody else in the government-led, but let's see what the counterfactual could have been if crude oil prices were high. This is prior to COVID. During COVID, of course, they declined to $20, $25 per barrel. I had one picture here, which is perhaps hidden, which is on agriculture. Monsoon was good that year. Monsoon has been good all of last 3 years, which meant that agriculture sector grew at 4%, more than 4% during COVID and the year after. Again, a counterfactual which would have been very, very different had monsoon failed that year. No matter what we had done, would not have sufficed. Now again, comparison with advanced economies is useful, but let's also compare India with select other emerging markets. And here I'm just borrowing my slides from another presentation, which was on Asia and India and rest of Asia, India and rest of Asia. So therefore, the countries sample here is somewhat selective. But let's look at the real GDP growth, average annual real GDP growth for 3 years, 2019-20, 2021, 21-22. Pre-COVID, COVID, post-COVID. Average growth rate for India for these 3 years is about 2%. And compare it with some of the other countries, Vietnam, Indonesia, and others. Others have not done as well, I agree. Inflation, average 5.5% for India. Other Asian countries have much lower inflation rate. Fiscal deficit, India has always been an outlier, and there's a way that India manages its outlier position without getting the bond yields through the roof. Most of public debt in India is domestically held, and it's held by the institutions, mostly, which are owned by the government. So it's a large joint family syndrome that we have, right? Which means that bond yields stay range bound, and you don't get market reaction. But the harsh reality is that fiscal deficit, average of 3 years, was 10% in India, and half that level in the Asian countries that we have here. Public debt to GDP ratio is about 83 here. It's currently around 85%, again, much higher than in other countries. Now, let me just focus a little bit, a minute or two, on our sticky fiscal math. What does it mean? Despite being prudent, despite making a shift of our fiscal towards capital expenditure, are we in a very safe, prudent zone? Here what I'm showing is actually from some slides I had after the budget, presentations on the budget, so it's for central government. But a similar picture you can see for general government, which includes center and the states. Interest payments of the center, despite all the prudence and shift towards capital expenditure, is nearly 3.5% of GDP. When you include the states, that ratio goes above 5%. It's 5 to 5.5% of GDP is paid in interest payment. But again, it's not a worry because it's going from one part of the family to the other, right? Which means it just looks kind of safe. Interest payments exceed 40% of the revenue that the central government collects, a similar number you get for the general government. Now, we have done some debt sustainability analysis, or let me call it evolution of public debt. Under the usual assumptions could be the three variables that matter for the evolution of public debt: your nominal GDP growth, your bond yields, and your primary deficit. The deficit that you run on non-interest accounting for only non-interest payments. Under the business as usual scenarios, which would be that nominal GDP growth would be the level of 5 pre-COVID years or 10 pre-COVID years, and similarly other variables would be at the level of 5 or 10 pre-COVID years, debt to GDP ratio is not going to stabilize. It will stabilize only if nominal GDP growth is much higher than has been the case in the past. And even then, it's a very slow decline from the levels that we are at. Similar story for central government or state levels separately. So to sum up, a very interesting, comprehensive, and relevant paper that I was asked to discuss, and I really enjoyed reading it, and I enjoyed the presentation even more than the paper. India has definitely emerged rather unscathed from the impacts of COVID. So I attribute it to the fact that India was already in a very strong position when COVID hit. There was political stability, there was policy stability, there was macroeconomic stability. India had laid down the financial inclusion, technology, and digital adoption infrastructure, which helped India come out of the ravages of this pandemic. Yes, India's response during COVID was timely, responsible, well-sequenced, and prudent. There's still work that needs to be done. The growth needs to be sustained and accelerated. Accelerated growth in manufacturing, for example, still remains elusive for India. Macroeconomic stability ought to be maintained. It cannot be taken for granted, neither from the central banking side or from the fiscal side. Just one last chart before I move on. This is manufacturing growth rate for the country. Decadal averages of 3 years, 2019-20 to 21-22, 2.1%, and projections for this year. Despite all the hard work that we are doing, it's still estimated to be 1.5% this year. I'll stop here. Thank you.
So, okay, maybe what we do is you take maybe 4 to 5 minutes with some responses.
Yeah.
And then we will have the questions from the floor.
So first of all, thanks a lot, Poonam. I think that's a very, very good discussion, very comprehensive, and especially I think, given that this paper was sort of a very preliminary stage, some of the comments you've made will really help in sharpening the paper significantly. I agree with a lot of comments that you've made. I will, but I'll sort of nuance it a little bit. So I think broadly, if you look at the comparison, so there are 3 sets of comparison that I think can be made, and in the paper we've primarily done 2 sets, but your comments are I think useful in maybe even narrowing down further. So what are those 3 sets of comparison? One is with advanced economies, India vis-a-vis advanced economies. Second is India vis-a-vis other emerging economies. And third is India, just within India itself. Previous crisis was global financial crisis versus India during COVID. I think your comments are actually sort of, I take them in the spirit that the third comparison is where I think the sharpest, a more ceteris paribus kind of comparison can be made. So that's where I will respond to some of your comments. So, you mentioned about the political stability, policy stability, macro stability. I think that was as true for India entering, the global financial crisis as it was for India entering COVID. As you quoted out, for instance, the current account deficit, and I quickly pulled out the numbers while you were talking. So if you look at the current account deficits pre-global financial crisis, and I'm going to quote these numbers, it was 1.5% for 2006-2007, 1.2% for 2005-2006, 0.4% for 2004-2005, and a current account surplus of 2.3% for 2003-2004. So, if you look at the external sector as well, going into the global financial crisis, I don't think the precondition was actually was bad. So, if anything, the Indian economy entered global financial crisis very smoothly. And I think the contrast there is something that I would definitely want to emphasize. You enter very smoothly into the global financial crisis. You exit out with a with a triple whammy of a very high fiscal deficit, very high current account deficit, and very high inflation, to the extent that inflation was in double digits every month for 18 months, leading up to a series of accidents that eventually ends up in India being part of the Fragile Five. That's a comparison that I'm actually absolutely comfortable with. In contrast, India enters, yes, with some of the conditions that are beneficial, but at least on the external fronts, I think CAD was fine, but the important concern about the sovereign rating downgrade was not there, in the global financial crisis period. Now, second set of comments, I think, and I take that completely on board. Some of the other preconditions, which I think I'll try and include it in the paper. Yes, absolutely. I think the work that was done before COVID indeed helped a lot. And I will, admit that during COVID, so many times I sort of, really thanked our stars that we had done so much work on the digital infrastructure, because just the counterfactual, thinking about, if it were, if not for that kind of digitization, having people line up for, for basically getting, let's say, the money instead of a quick, just a one click to send money through the direct benefit transfer Jam Trinity. I mean, that would have itself been a super spreader. So absolutely, I think some of the work that was done pre-COVID indeed helped a lot. I will focus on the transparency, and I'll have no hesitation in taking credit for that. For the transparency in the fiscal. Yes, we definitely cleaned up. There were 2 budgets that came before. Actually, 3 budgets that I was involved in, pre-COVID, and we wanted to make sure that that the fiscal math is indeed presented very transparently. And I will contrast, vis-a-vis. Take the budget before the global financial crisis, when the farm loan waiver was announced. The fiscal deficit that was actually put on, was announced was 2.5%. The actual number of, if you include the farm loan waiver, the 6 pay commission recommendations, and the oil bonds that were brought in, all of them were below the line. There's now work that shows that amounted to 3.5% of GDP. In other words, what was actually 6% of GDP was shown by the then finance minister as 2.5% of GDP. So I think the transparency, the cleaning up of the banking sector. Some of the cleaning up of the banking sector, though, happened during COVID itself. And I think the financial sector, to give credit where it is due, it helped that they actually entered, with the reminder of the previous problems very, very fresh. So it was a case of once bitten, twice shy. And I think, therefore, they actually deleveraged significantly. So overall, just to sort of conclude my responses to your very valuable comments, I think the comparison of India's response during the global financial crisis vis-a-vis COVID is absolutely kosher. There is a very clear ceteris paribus, that can be made. Bottom line is India enters, smoothly into the global financial crisis, but gets out actually in a shambolic situation. Enters COVID, with more challenges, but with some good work done already. Benefits from from some of that good work that has already been done, but also surmounts the challenges that the COVID posed. So that would be my bottom line for how I would compare, and I would actually thereby focus on within India comparison. And I'll end with, I think this comparison tells you that maybe even the comparison with some of the other emerging economies maybe is not right, because there are other differences that come up as well. I'll stop there. Thanks a lot for your comments once again.
Thank you, Subbu. Okay, so just a couple of comments of my own, and then we open to this. I think, there is one value to the comparison with the advanced economies, I feel, which is the way the advanced economies bossed it by going so tong and hammer after expansion of these transfers. I think that really hurt, and that had actually the echoes of those measures back in India as well. Everybody ganged up on the government that they should do more and more, and they should print money and so forth. I think, inside the government you were the only one, outside I was the only one who was making the opposite point.
Quietly in the World Bank, I was the third one.
Sorry?
Quietly in the World Bank, I was the third one.
Oh, you were the third one, okay. So, very good. Okay, so I think that was clearly a very different response by India than practically by the rest of the world, and also against the advice that everybody was heaping on India. And Indian government really had to stand really firm on this in opposition to the pressure that was being exerted on it from all around. Just a second point, comment following really from what Poonam had said, that it seems that demonetization, ultimately the timing of it, was a blessing in disguise. I mean, you're all, both of you are agreeing that actually the digitization proved to be a key, and there is no doubt that actually whether digitization was one of the objectives of demonetization or not, that to me is neither here nor there. Yeah. The point is that it did lead the government to really double down on digitization. Yeah. I was at the Niti Aayog at the time, and I know how hard we worked actually on digitization. So that certainly ties in very nicely when people try to evaluate demonetization. So anyway, we'll open.
So can I just respond? Sorry. I think add to a couple of your, I think those observations. So I deliberately did not want to go into demonetization because that's one thing that generates a lot of emotive responses, in the audience here. And I did not want the focus on, what I'm talking about in the paper to be taken away by the, debate on demonetization. But I agree with you completely, Dr. Panagariya. I think the amount of work that has been done, the counterfactual, which is if demonetization had not happened, I'm absolutely comfortable saying that we wouldn't have been in the kind of situation on the digitization, that we were actually. That I'm absolutely comfortable saying.
Just very quickly, I'm strategically quiet on that.
Okay. On the advanced economies, and you're absolutely right, Dr. Panagariya. There was a interview that I gave to Economic Times. It was there in the front page during this time when the package was being worked on, and the headline was "There is no free lunch. You cannot do economic policy pretending that there is a free lunch." And I remember how much I was trolled on Twitter, including people saying that, oh, you're eating our money and stuff like that. So, but the point I think that you've highlighted, I agree with you there, because one of the threads that I've put out on the current banking crisis, I didn't have time to cover that, but and I want to just sort of comment on that very quickly. If you look at the response, in the US and other advanced economies, it was not targeted. Now, one of the cardinal principles that most of us who actually think about macroeconomics recognize is that the marginal propensity to consume is actually very high for the poor, and therefore, any money you give to the poor actually shows up in consumption, almost one for one. In contrast, the marginal propensity to consume is actually much lower for the middle class, and even lower for the rich. Now, I'll mention a specific anecdote. Friends of my daughter who are actually studying at the University of Chicago. Now, these aren't poor. They got $5,000 checks during COVID. Where does that kind of money go and show up? It obviously shows up as savings, and that is why if you see and the current banking crisis, yesterday I was on Bloomberg saying this, that the original sin was of the US government, because they did not target the fiscal spend. As a result, actually it shows up as deposits, a 5 trillion increase in deposits in the banking sector. Because a demand did not pick up as much, and steroids can basically create demand only for so long. The lending increased by only 2 trillion. Where does that remaining 3 trillion go? The remaining 3 trillion has to go somewhere else. It went into reserves, and 1.3 trillion into US treasuries and agency securities. Now, when you combine that with actually the 5% or about 5% increase by the Fed, you have sitting on 600 billion north of unrealized losses, and that is what is basically creating the banking sector problem. So I'll end by giving you this parallel, from the Indian experience during the global financial crisis. What I actually came to learn is that when you do, profligate spending like that, it leads to a series of quote-unquote accidents. These seem like accidents when, they actually are, because of the original sin of spending like there is no tomorrow. And I think based on that, I feel like there's more trouble coming for the US, because they're also, even to these, they're actually coming up with very myopic responses. So we'll wait and watch.
Okay, so floor is open.
Professor, is it okay if we can club 4 or 5 questions so that the panelists can respond to them? 4 or 5 questions?
We'll do 3. I think
3?
4 or
Okay,
5 is too many. Let's do 3. Okay, Isha.
Okay, fine.
No, let the microphone come. It's all getting recorded.
Okay. Just when we talk about inflation, I was wondering if you have something to say about global supply chain, given that in the US, inflation was partly happening because US was importing a lot of stuff from China. So if you can say something about that.
Okay.
I have a question on the last slide from Poonam. What's the reason the manufacturing is not able to pick up post-COVID? It's very slow progress, it seems. I just wanted to know the reasons for it in India.
So what is not able to pick?
The manufacturing.
Yeah. By the way, we'll also have a session on this very subject, but we'll take the question. Okay.
Why was the Indian government so stingy in providing for the vaccination? They somehow or the other did not react to it quick enough, which probably could have been helpful for the second wave.
Okay. On the vaccination, I think, I wouldn't call it stingy. See, I can share now that the pharmaceutical companies here, when we were in talks with them, while we were developing the indigenous vaccines, they were asking for conditionalities that the US government did not give. They actually, that was not acceptable to us at all. And the way they actually were interacting, one set of rules for the advanced economies and another set of rules for the emerging economies, which we were very clear we are not going to, be subjected to. As for the vaccination, if you look at, I think India has done really well on the vaccination. I think the second wave was very bad. I would sort of contrast the what could have been in the first wave if we had not had the lockdown. The second wave provides a very good sort of picture of that. I think the way I read it was some of the various aspects, including some of the political things, vaccine, the acceptability of the vaccine, and possibly the desperation to get a vaccine was not there at that time, and that's what I think led to the second wave. Once the second wave was there, everybody then realized that this is dangerous, and therefore, so I wouldn't attribute it to the scarcity. As for the manufacturing, I think, as Dr. Panagariya said, there is a panel. I think in one-on-one I'll have a discussion with Poonam, because I would want to see where those projections for growth, etc., coming for this year. I'm curious. And as for inflation, I think you were talking about yes, the global supply chains indeed got disrupted. That's what I was saying. That was actually a critical part of what I covered in the paper. Of course, one can articulate it much better now than in March or April 2020. If you had asked me then, I would have not been able to articulate it as well. But I could intuitively sort of say that, look, if you're going to have people being asked to sit at home, not going to factories, not producing, there will be some parts in the overall value chain where some firms may go belly up, and you will have supply chain disruptions, and that is what made us clearly recognize that the supply side is important. So absolutely, that's the bottom line. I think even now, if the US actually focuses, adequately on the demand side as well, on the supply side as well, not just the demand side, the growth sacrifice and the problems on the banking sector will actually be much lower than they currently are.
So let me just take a few seconds, hopefully. Isha, on your question of the US inflation, you're absolutely right. Two factors certainly: excessive demand stimulus, supply chain, but a third is the labor supply, which shrank during COVID. They are not terribly excited about immigration. And no matter how much they tighten their monetary policy, your non-tradable inflation now is not going to go away, because there are just very few people. Now, unless you really shrink the economy, which I don't think anybody can afford to, and perhaps they can. So a part of the solution is very, very structural. They have to expand the labor supply from abroad. On manufacturing sector, so there are two interesting things about this sector. One is, it does not only matter how well you are doing in an absolute sense. What matters even more is how well are you doing compared to the global best players. And those global best players are so much more efficient than India currently is, that despite all the policy effort that's going into the sector, we are still not close enough to displace the largest players in this sector globally. So that's one thing. Second is, this sector is very intensive in the use of inputs, labor, capital, regulation, land, that getting it to work it well in a global sense is a lot more work than we have been able to do. Skills is another challenge that's emerging. So as a part of this paper that will be presented and possibly in the panel discussion tomorrow, these are some of the things we can discuss. That, you know, large part of the reforms that were started 30 years ago, more than 30 years ago, have been focused on the manufacturing sector. But because of these two factors, that it's so intensive in the use of scale, land, skills, labor, finance, that those efforts have not added up in a relative sense, even if they have added up in an absolute sense. I'll stop here.
I just had a question about the claim that there's been no scarring, and both of you presented a picture that India's response has been quite strong during COVID. I wanted to understand, how would you explain the fact that the GDP level today still remains more than 10% below the pre-pandemic trend? Take whatever projections from IMF or World Bank or wherever, the level of GDP still remains. So is our assessment of a strong recovery and no scarring correct, or are we missing something? Thank you.
Hello, wishing everyone a good morning. I also wanted to understand what are the causes and concerns that are creating the depletion of the Indian rupee, and your thoughts on the same.
Hi, thank you for the presentation. As I understand, the advanced economy, especially US, did some sort of like free, untargeted stimulus packages, whereas India did a more targeted and market-based COVID package. 3 years later, we see US fighting inflation, which is much higher than their decadal average, while India is in a very much better shape in terms of inflation. How much of that would you attribute to the COVID response of India? Like the strong fundamentals right now, especially inflation, how much of that would you attribute?
Okay, so let me take the last question. I think the whole point of my paper, incorporating some of the comments that that Poonam made, which is if you take some of the work that's been done on digitization, some of the cleanup on the fiscal side, a lot of the work, together with the fact that we were the only country to recognize that COVID is a supply side shock. No other country, recognized that, at this, it's one thing to recognize now ex post, but ex ante to be able to recognize. So I wouldn't have that much hesitation in saying that, some of the work that's been done leading up to COVID, plus the diagnosis of the COVID crisis and thereby, the response. I must give, it's one thing for an economist to be able to diagnose the problem and be able to, suggest solutions. Another thing for the decision makers to actually listen to that economist and implement the suggestions. So a lot of credit has to go, to the Honorable Prime Minister, for listening to some of these suggestions and actually implementing there. So bottom line, I think the work that's been done before and the analysis of the crisis and the implementation does deserve a lot of credit. I wouldn't attribute it to just luck. Because I think the contrast with the global financial crisis or even advanced economies, I think is palpable. Now, the first question, I think, on the overall GDP path, look, you have to take into account that if you have a country that is growing at, let's say, 2.5%, versus a country that is growing at, let's say, 7% or 6.5%, the slopes are very different. A slope for for basically a 2.5% growth line, GDP, the line is very different. It's far shallower than that for a 6.5%, 7%. Now, that's point number one. Point number two you take into account is lockdown meant, that every one of these countries actually, whether you were at a 7% path or at a 2.5% path, during the time of the lockdown, you basically were looking at very, very little economic activity. And so when you compare, let's say a 0 with a 7 versus 0 versus a 2.5, obviously you are looking, you see the mechanical impact. So when you take into account the GDP, the GDP path, you have to take into account also the slopes. There is a mechanical effect there, which you have to be careful about, which I think is really as for the overall recovery. I think with I provided you that comparison with inflation. We've had basically manageable inflation with with growth that is highest among the large economies. And as for the lockdown itself, and that's why I covered this, because I think the economic response itself cannot be departed from the health response, given the health infrastructure India had, given the population and the population density and the network effects with which a pandemic spreads. I think it is important to take into account the lockdown intensity itself, which was an endogenous response to these conditions. And therefore, when you interpret what you're saying, you have to keep that in mind as well.
To go back to Ruchi's question, Ruchi, I don't find that framing to be useful at all in the following sense. You're looking at the size of the economy, right? And you're looking at the trend rate. And then a shock happens in which suddenly a lot of demand just goes away. There's an intercept shift. It goes down. Then it has to grow at the same slope as before. The haircuts that were not taken, the manicures that were not done, the transport that was not taken, the flights that were not taken, you cannot make up for that, is my interpretation. But you're shaking your head, which means you don't agree. We can talk about that.
People's incomes are still, to clarify, if I may, people's income are still 10% lower than it would have been in the counterfactual scenario. In the United States and a few other countries, we are back at the pre-pandemic trend. And so the question is not so clear just because you've lost income last year, your income should be persistently lower this year. So I'm not saying necessarily that we should necessarily come back to that level, but my question is, are we missing something by painting the picture that was painted when you look at the fact that people's income is still 10% lower than the counterfactual compared to the pre-pandemic?
Which is why I mentioned, at what rate was the income growing before the pandemic is important, that's a mechanical impact, right? If your income was growing at, let's say, 2% before the pandemic, it's far easier to recoup that than if your income was growing at 7%. Of course, not just that, the level at which basically the growth was happening is also important. So I think I agree with Poonam that this is there are a lot of conflating factors that are going on here to make the kind of statement that you're trying to make.
And Ruchir, the US story is not over yet. Let's see what happens in this year and next year, right?
Yes.
And they're trying to slow down the economy. So their super story is valid. It was temporary stimulus, and let's see what comes out of it. On exchange rate, that's a different story. It goes back to the reason why I don't think comparison with advanced economies makes a lot of sense. They issue hard currency. They can get away with a lot. And when they do all their stimulus and withdrawals, it's emerging markets like India who have to bear the brunt. So current exchange rate depreciation is a part of that. But at the same time, not all exchange rate depreciation is a bad thing, right? But we can have a longer discussion on that during coffee. Thanks.
But let me just add on the currency depreciation quickly. I think if you look at the relative, depreciation, I think the macro fundamentals actually do reflect the relative, depreciation. If you compare the global financial crisis period, India's, the rupee depreciation was among the worst, even in a relative sense. While now, if you look at, yes, all currencies have depreciated, and why? Because of the combination of flight to safety together with home bias. A combination of that. We can expand on these jargons, but I think overall India's currency, doing much better in the basket of currencies is reflective of the better macro fundamentals.
So just on Ruchi's question, I think requires a little more thinking. I understand both the sides here. Ruchir's I understand because what Ruchir is saying is that, look, there is still some scarring left. Right? That's what you're saying. Your point I understand only in the extreme form, which is that suppose the GDP was not growing at all in the advanced economies. You dip, you come back up, and you go back, so it's a V shape, and there you go. In the extreme case, I sort of see it. In the less extreme case where you were growing previously and therefore you would have been in a different spot had there not been this dip during this period. Not quite sure how that works, but that's how. I think
the way I'm thinking
a little
about
bit more thinking.
Yeah, the way I'm thinking is if you think about the area that is lost.
No,
right?
look, that won't only mean that the gap will be perhaps in absolute terms less for the US than it is for India. But you know, if you were equivalent, then scarring would have been left for both. But if scarring has not been left for the United States, then there is a difference. Now, as I said, I do see what our esteemed speaker is saying. Also, at least in that very extreme case where there is no growth pre and there is no growth post, but you know, you go down and come back up. So anyway, we can take maybe a couple more questions. Mary?
Thank you, and thanks for the presentation and the comments. So I think in the United States, we were very happy to see the performance of India. There was a great deal of fear that the COVID virus would, you know, really have decimating effects in emerging markets, and India performed admirably. So that is not to be contested, and I think today we saw some of the reasons why. But I do want to stop the Indian victory lap for a minute, and that is to say that I don't think it's accurate to say that India was the only country that recognized it was both supply and demand and responded in that way. And as a key point, I will point out the U.S. Paycheck Protection Plan, where the U.S. spent a lot of money to make sure that businesses did not fold. That is to keep supply there so that when the lockdowns were lifted or restraints were lifted, businesses would still be able to operate. So I think this is at least one important counterexample. Secondly, you argued that India didn't push down on the accelerator while clamping down on the brake. That's a very powerful, picture to have in one's mind. But the immediate need of people was obvious. India recognized this and provided the food stocks. Well, here I guess I have to say you proved that there is such a thing as a free lunch because you were able to go to your food stocks. That was not possible in the United States. People here would not have accepted food as a handout. People would not have seen that as obvious when they were losing their mortgages. So in response, there was a, income supports were used. In hindsight, we may say they were too big. At the time, I think they were the right thing to do. So my point is, same objective, but different instruments. You had the food, it was culturally appropriate, it was not so in the United States. Lastly, I want to argue about the shift in the aggregate supply curve. You know, when you have the aggregate supply curve, it looks like it's immediate. We have the pandemic seems like an eternity for us, but it was a couple of years. And the U.S. chose to try to keep its supply available through things like PPP. CapEx takes a long time to come on. So I really wonder, how did your CapEx spending actually really provide supply expansion? What it actually would have done would have raised demand in the short run by increasing demand for steel, for cement, et cetera. So I really question that you are the champions of supply side. Lastly, on scarring, it's wonderful that you rolled out digitization. It's on a global scale, it's impressive and incredibly important. But 40% by the numbers still don't have access to digital. And then the question is, what happened? Because I think you had 58% on your slide. digitization. Look at the slide and see. But whatever, there's a sizable portion of people in India who still don't have access. What happened to them in terms of access to continuity of education and other types of supports? We are finding out in the United States that this is having a permanent scarring on our children, and I doubt that India is going to get away scot-free. So, and lastly, I'll just add that China, for all of its faults, and there are many, we could spend the entire conference talking about them, has its economy is about 13% larger than it was prior to the pandemic. So bringing it back in a country that has a growth rate of above 5% is possible. Thank you.
That's a fantastic intervention. I think we are out of time, so if we can.
I think you have to allow me to intervene.
We'll give you 2 minutes.
Yeah.
But I also don't see our speakers yet for the next session. But we'll have a coffee break after that. So you respond, Subbu.
I think points are well taken. Let me respond on. See, the point that I was making was, yes, the instruments were different. I wouldn't call it cultural. As I mentioned, even here, there is research showing that the checks that went out during the lockdown, those were spent on essentials. So the money was indeed spent on essentials. India, because, and I don't call that actually that there is a free lunch. We had paid for it earlier. We just used it, and that was the wise thing to do. I will still push back on the fact that, and I hear a lot of commentators saying, I think giving a sort of an easy pass to the policymakers by saying that, this is hindsight. All I am saying, and I think maybe in the presentation it came out far more stark than I want it to be. The difference I'm talking about is in degrees. In India, we recognized far more a priori that this is going to be a supply side shock, and thereby actually took far more measures. Yes, I agree with you that some of those measures taken for MSMEs actually were supply side. I think and I'll nuance that. Thanks for that point. But I think the difference in degree absolutely still remains. And so if there is one country that could have recognized, the degree to which this was a supply side shock and another country did not, then I think then saying that, this is all hindsight, I think is incorrect. It doesn't give enough credit to those that had the foresight to be able to see the degree to which it was a supply side shock. I think that's the, there were a couple of other comments, I think that, but let me conclude by saying, I don't want to actually make this seem like a victory lap. I think with any economy, nothing is ever a victory lap, or nothing is ever actually just a defeat, go down. It's just to look at, at 3 years after the pandemic, what is it that we did well? Am I saying that we basically can just go to sleep having responded well to COVID? Absolutely not. There are an enormous amount of challenges. But let me actually say, and I'm going to use I have no hesitation in saying this. If, for instance, just reverse this, India having done what the US did, and US having done what India did, all the newspapers and the channels would have basically been treating all the policymakers like God.
Okay. On that note, coffee break, and we'll come back. We are still waiting. I don't see the speakers for the next session, but I'm sure they'll be here.